Have you ever wondered how someone with a little extra money in their savings account helps a large company build a new factory, or how an individual can afford to buy a home without having all the cash upfront? It seems like a complicated dance, bringing together many different financial needs and goals. Financial intermediaries are the essential organizations that connect individuals, businesses, and governments that have surplus funds with those who need capital for investment and spending. They act as vital go-betweens, making financial markets function smoothly and efficiently. The primary reason these intermediaries are so critical is their ability to overcome significant barriers that would otherwise prevent efficient capital allocation. For example, they drastically reduce information asymmetry, meaning they help both savers and borrowers understand each other better. They also lower transaction costs because it is much cheaper to deal with one bank than to find hundreds of individual lenders or borrowers. Furthermore, they provide crucial liquidity by ensuring that savers can access their funds when needed, while still allowing borrowers to utilize capital for long-term projects. These organizations include familiar names like commercial banks, credit unions, insurance companies, and investment funds, each specializing in different aspects of financial facilitation. These intermediaries achieve their roles through several key mechanisms. They transform assets, for instance, by taking many small, short-term deposits and pooling them into larger, longer-term loans for businesses or mortgages for homes. They also manage risk by diversifying investments across many different borrowers and projects, making the overall financial system more resilient. Additionally, they provide essential payment systems that enable commerce and offer expert financial advice to both their depositors and borrowers, guiding them towards better financial decisions. One interesting detail about their function is what economists call maturity transformation. This describes how banks take short-term deposits, which savers might want back relatively soon, and convert them into long-term loans for things like infrastructure projects or business expansion. This process is absolutely fundamental for supporting economic growth by funding long-term productive investments, which would be very difficult to finance directly between savers and borrowers. Ultimately, financial intermediaries are not just middlemen but, rather, sophisticated engines that lubricate the entire capitalist system. They enable the efficient flow of capital, turning scattered savings into productive investments, which in turn fosters innovation, creates employment, and drives overall economic prosperity. Their presence transforms a potentially disjointed financial landscape into a robust and dynamic engine for progress.